Right, good morning, ladies and gentlemen. I think we have approaching 10. If we can commence the meeting. Good morning to everyone. Hope it's a little damp this morning, but not so nice. It's lovely to see you all here once again. So if I could, I'll turn to Robert and we'll start with item 1, which are apologies for absence. Robert, thank you.
Apologies received from Councillor Stokes and Councillor King. We've also received apologies from from Mr. Hallenby. Thank you, Chair.
Thank you. Moving on to item 2, we have declaration of members' interests. Do members have any declarations at this stage? No? None. That's great. Thank you. Item 3, I will, obviously I wasn't chairing the meeting on the 12th. I do apologise. I had to, I couldn't attend on that day, so Mark very kindly chaired the meeting. So I'll perhaps leave it to Mark to propose that item, if that's okay. Well, probably just ask if there are any matters arising from this. I know we had a briefing note from Robert. Thank you.
Quite happily to second that.
Yeah, thank you. And we do have, all of us, the briefing note from through David Ingram about the records management system as well, don't we? Which came the other day. So we'll thank everyone for furnishing us with that. That's great. Thank you. If we could have a show of hands, please, for that we agree that, please. Thank you. Thank you. Right. If we can move on to item 4, which shows the updated draft statements of accounts for 2021, and I'll hand over to Michelle, if that's possible. Thank you. Thank you, Michelle.
Hi, this is just an update on where we are with our work on the statements, and Sue's going to actually go through the changes with you, if that's okay, Chair. Thank you very much. I'll hand over to Sue Maycock.
Thank you, Chair. This report on the updated statement of accounts follows on from the report on the draft statement of accounts presented to the committee on the 12th of July. At that time, the external audit had started and it's been progressing ever since. In the next item on your agenda, Mazars will update you on the current status of the audit, but to date we can report that no significant issues have emerged. So this report presents an updated statement of accounts, which includes all of the amendments made up to the point of publication for this committee. And these comprise both minor corrections and adjustments arising from the auditor's scrutiny of the accounts, as well as some more significant adjustments to the pension fund asset valuations, which have been initiated by officers. At the 12th of July meeting, we reported to you that as at the 31st of March, there were a significant number of unquoted holdings amongst the pension fund assets, where the 31st of March valuations had not been received, and as they were received, they would be incorporated into the accounts if the changes were considered to be material. The materiality level for the pension fund accounts is 27.4 million, and the total value of adjustments that are needed is 33.9 million, so they have been made. The version of accounts you see today haven't quite got all of the adjustments in, and that's due to the cut-off for publication for this committee, but they will be incorporated for the final version that you do see. In Mazars' report, this change to the pension fund asset valuations is described as a material misstatement. We consider it to be a planned for update to the figures in the accounts. You have a link to the updated accounts, and Appendix B lists the changes that we've made. And finally, as we won't be able to publish our accounts by the 30th of September, which is statutory deadline for publication, we will be publishing instead a notice on the council website on the 30th of September to explain that publication will be delayed until after the audit has been concluded. And we expect to present the final accounts to you at the November Audit Committee. They are the key points. Happy to receive any questions.
Thank you, Sue, for the information around the accounts completion. And we'll perhaps now pass over to members to get their views. Mark.
One question I was going to ask has been answered by the fact that we intended to put a notice on the website. informing presumably people that may be interested that we have a delay. Is there any statutory requirement to inform any organisation that we're not going to meet the deadline and there is a delay?
I don't believe there is. I think publishing this notice on the website is what's required to do that, and that's what we're intending to do.
Fine, if that's the case, thank you.
Thank you, Sue. Thank you, Mark. Looking around for any further questions for Sue. Obviously, we've scrutinised the accounts in detail on previous occasion. Paul, thank you.
Thank you, Chair. I just wondered if the delays are due to new process, and are we looking in the future to plan better, because this is really quite irregular, the delay.
I think actually it's probably down to questions from the auditors. Michelle, would you like to come in on that?
Yeah, I think we've done everything to the timeline that we'd planned to do. In terms of we knew that the deadline is later than what it normally is, but still earlier than it was last year. So we've been working to a planned date of the end of September, and we have provided everything, I think, to the auditor when we've needed to. I'm sure Mazars will have some comments about their planned work and any problems they've had, which you can pick up on the next item. But in terms of, we plan our work quite thoroughly, I think, and I don't think there's been any particular issues with us planning our work.
Thanks for reassurance.
Thank you, Chairman. I was going to raise the same sort of questions, but I think these are questions for Mazars rather than anybody else. Is that correct?
I think you might want to come back to officers once you've heard the update from Mazars, and if that's helpful, then I'm sure it'll be easier probably to answer those questions at that point.
So let's hear what they've got to say before we go any further. Thank you.
Thank you, Mark. Andrew.
Thank you, Chair. This is one driven by the news this morning, Michelle. There's a few audit companies that have fallen below best standard. Grant Thornton is the latest, others have done it, etc. Has that impacted upon the demands that these big audit firms are making upon you, extra tests, extra assurances, etc.?
I think Mazars can probably comment on what they're asking of us. I think they're doing more testing, and they're doing more quality assurance of their own work. I think it's been maybe hindered a little bit by the audit code that's changed a little this year, and there's obviously more emphasis on what they are looking at, which is more of an issue for the auditors rather than us, and how they do their work. They've had to do some extra work with the actuaries this year, and things like that. So I don't think they're making more demands on us. I think they've always been fairly demanding, to be fair, and we plan for that. But I'm sure Mazars can update you on the additional work that they've had to do around some of the valuations in the accounts.
Thank you for the question, Andrew. Thank you, Michelle, for the response. So, any further questions, members of the committee? No, we have the recommendation, which we were asked to comment on the changes, which I think is basically we're carrying forward some of those comments in the next paper. So, could I have a proposer and seconder for that recommendation? Thank you. All those in favour? Thank you. Thank you, members. Thank you for officer updates. So moving on to item 5, this is the update on the progress of the external audit of the accounts 2021.
So just by way of introduction, it is obviously a follow-on from the LCC update, and hopefully we should have, I think, Mark or Michael on the line to give an update from the Mazars work.
Good morning. I hope you can all hear me clearly, but please do interrupt me if you can't. I've made a couple of notes of the questions that were raised in the previous one, so I will make sure I try and address those as we go through. I'm going to take over talk you through the position on the financial statements. I've got John Presley with me, who will pick up on the financial statements of the pension fund. I just intend to highlight a couple of areas and give you some context. So our report's status of the audit is page 20 of your pack. We start by talking about the positive assurance and positive assistance that we've had from management as a result of what has been, frankly, a year of financial statement, financial reporting and audit delivery much more challenging than last year. And we've seen that across the piece. Councillor, you asked a question of could the council have done any more to plan as a result of this? I would say fundamentally no, because what we're seeing is is essentially a snowball effect of COVID. It's an 18 months of increased workload for all individuals involved, both auditors and financial reporters, as well as finance teams, that has just has pushed things has pushed workloads up. And I'll come on to this in broad terms. What we're finding is that is exacerbated across the entire economy in terms of professional accountants, valuers, actuaries, etc. We are seeing quite a considerable increase in COVID sickness absence as well, not just remote working, but pure sickness. So it's had a cumulative effect. So it's not there's no quick fix for this. This is an output and an outcome of the impact that COVID's had in terms of the workload that everybody's had to deal with. The second point I'd like to point out is what we've set out is the significant audit risks that were in the audit plan. And the important point I want to make here is that the audit risks that we thought would be and the areas that we would need to pay special attention to as part of the planning are the same as they are now. And that just reflects that having deepened our dive into the authority's financial systems and reporting environment, we're satisfied the risk profile hasn't changed, even though there's broader uncertainty in terms of all the challenges that local authorities are facing. So that's a good point. We do talk about a couple of the significant risks on page 21. The two that I just want to draw to your attention here is already mentioned in the pre-conversation about the movement on the pension fund. And again, we'll pick that up, but obviously it has a cascade effect through to your accounts, but also the accounts of all the district authorities. This movement itself is not unusual, and I think that's also important for context. We've seen similar movements in other counties. And just because the numbers are so big, essentially you're moving from estimates to actuals, they need to be reflected in the financial statements. They are complicated and they do have quite a considerable run through the financial statements, so they impact multiple areas. But what I would say is that whilst it affects the disclosures, it doesn't have any impact on the general fund figures at all. The other area I just wanted to draw to your attention, property valuation. It's a very, very large, complex area involving lots of judgments and estimates. We've engaged our own valuer to have a look at the investment properties called county farms this year. That work's been completed and we have no concerns to raise that would lead to an adjustment to the accounts. So that is, again, positive assurance. The work there is ongoing because we have got a number of queries with the valuer, but they've been affected by COVID. The experts have been unable to respond as quickly as they would have liked to because of their own sickness and annual leave that's got in the way of that process. Whilst I'm pausing on this page, Councillor, you asked a question about audit quality. The The audit quality agenda is very, very important to us at Mazars. We've been inspected by the Financial Reporting Council. As always, they always find areas that they would like to seek us to improve on. The two biggest areas are always pensions and property valuations. Our work programs have been adjusted to take account of that, and we have been doing a lot more work around the pension actuarial assumptions, judgments, and how the estimates in terms of the how the estimates go from calculation into the financial statements. So we've done a lot more work around that. And similarly, we've done a lot of work around property valuations. Whilst all authorities employ an expert to produce the work, we perform considerable sample sizes and really in-depth testing. For example, we go as far as looking at building plans to understand square footage measurement and ensure that's been the underlying books and records are complete, as well as looking at judgments in terms of the age of properties, the level of obsolescence, so what working state it's in. And how that's reflected, as well as, frankly, a long list of areas. And it does involve considerable additional work from ourselves. The finance team won't be directly impacted by that because that's the conversations we're having with the valuer. But I can assure you, it is a considerable step up in the amount of work that we do now compared to as soon as 3 years ago. I don't intend to talk too much more about the remaining audit risks because the work is progressed very nicely, but we're just kind of clearing those out, which we hope to do. And if I take you to page 23 of our report, you have a timeline. We are, as of today, the date we issued the report, we're hoping by the end of September to have all of our queries resolved and the majority of our procedures finished. It's been I mentioned earlier this has been a challenge. I mean, it's exacerbated somewhat, and a point that I think is very important to raise. I talked about workload on finance teams. The authorities' finance team, they've lost two very experienced members, and from our experience, and I oversee 26 local authority audits in the East Midlands. There is a real pressure on finance teams. Technical skills are very, very difficult to come by. And with all the additional pressures that have come through in responding to COVID, I think it's, and I mean this sincerely, I don't think you can underestimate the workload that finance teams have had to deal with. Whilst they're not necessarily, front and profile of, dealing with COVID, the amount of back office work that has had to be dealt with essentially a depleting technical skills base is incredibly challenging. And I see this replicated across the county, and from conversations with my colleagues, it is becoming quite a challenge. So looking after your staff is very, very important, and making sure there's some investment in maintaining skills and development, very, very important. As we move forward, we've got a timeline to finish the work by the end of November this year. I will mention the work around the value for money conclusion. A new code of audit practice, which we described in our audit plan earlier this year, was introduced. Guidance notes for that approach were still coming out in as late as June. So it's proven quite difficult for us to complete that work alongside. However, now that it's settled down, we expect to have that work completed in October so that we can issue the draft reports in line for a November reporting timetable. That's all I was going to talk about. I'm just checking my notes, and I think I've covered everything, all the initial pre-questions. But I am happy to take any questions in case A, I've missed anything, or B, there are anything else to come out of this.
Thank you, Mark, for all of of the information you furnished us with and going through your report. I can move to the members of the committee now, perhaps. Mark.
Thank you, Chairman. If you've been listening to the earlier part of this meeting, you'll be aware that we've had to put a notice, or we will have to put a notice out onto the council's website, explaining that we haven't managed to produce the accounts for the 31st of September as was intended. And I think that's probably about all we can possibly say, I think, in that notice. I don't suppose we're giving any particular reasons for it, is that right? It's a question for the officers, that.
Okay. I was halfway through saying, so, yes, that is correct. The requirement is for the authority to publish that note. It's not for us. But for context, I think that might be helpful for you in terms of where you are as an authority. There have been a number of, I think you're in the majority, the vast majority at this point, because there's been a number of counties that I deal with where they're only just getting notification of changes in the pension fund accounts this week. And there are some auditor technical issues around the requirements that have come out in the last week that are causing some delays. So yes, you're right. It's just a note that says the accounts are not audited yet, is all that goes on the website. But again, I wanted to give you that comfort that you're not an outlier.
Thank you, but that really wasn't the question. That was just to put my questions into context, I think, in terms of, we might start worrying the public who look at these things, and we need to be fully understanding about how that's occurred. I believe at the first meeting of the current audit committee, we did raise the issue about any uncertainties or any risk associated with failing to deliver the accounts on the 31st of September. And I don't believe that Mazars indicated there was going to be any significant difficulty. You did raise the issue about the new procedures that apply this time round, but there was no suggestion, I think, that was going to lead to significant delay. You mentioned COVID, I think, earlier on in your presentation, having some impact. But again, the comments that were made 2 committees ago didn't suggest that COVID might have an implication on it. So we're now got a new timeline with 2 months delay and an intention to produce the accounts by the end of November. It does seem as though this delay has suddenly occurred, because certainly as committee members we weren't warned about this some time ago. Have you got any more comments to explain what it is that might have happened, since you mentioned no risk in the first audit committee of this one, and what you're now saying?
So I think if I apologise, I can't remember the date of the previous audit committee, but I can take you through the key steps that have happened since then. So there was a slight delay in receiving the financial statements to start with, but I say it's an exacerbation of COVID throughout this year. Fundamentally, it has been driven by the fact that we've had staff, we've had staff members go off sick, which we couldn't have predicted. We've had a staff member leave. And it's an accumulation of those factors alongside the finance team losing 2 very, very experienced members that would normally deal with our queries, as well as the valuer themselves who've been off sick. None of those I don't think we could have or wanted to plan for.
Does that mean then, as a consequence of what you just said, that we can't guarantee any of the timelines that are put forward now and in the future?
I think there's always some inherent risk with timelines, but we have come up with this timeline in conjunction with the finance team, with officers, to make sure that we feel comfortable with that. My team are confident that they can deliver on that one. Obviously, I've got sight over the audit file about its state of completeness, and I'm comfortable. I would not have presented that timeline if I don't think we could get to it.
But it was presented and we haven't got to it. So I hear what you say, but I thought one of the benefits of it involving big firms in the audits was that the big firms have some degree of protection against the issues that you've just explained. But I hear what you say.
Well, thank you both for comments regarding timing and the allocation of staffing. I think, I don't know whether Michelle would like to respond with our staffing issues here, but I think we did deliver our, Michelle, you did deliver your documents on time. And I'd just really like to pose from the chair, both to Mark at Mazars and Michelle, if we can see this having an impact going forward on the production of the next lot of information, because clearly once you get into a delayed cycle, it tends to impinge on future work. Thank you.
Yeah, it'd be good to provide some context and some feedback from the LCC point of view. So we got the accounts to Mazars a week later than we'd originally planned to. I think that was the only delay from our side. I think Mark's right, we have lost some key people from the team. I think we estimated that we've had 4 people retire since Christmas and they've taken over 130 years of service with them, which is very difficult to replace, but I think the team have responded really well to that, and we've kind of backfilled and tried to respond as quickly as we can. I think some of the external valuations that Mark's talking about, so needing information back on updated pension fund calculations, not something we would have done prior to COVID. We would have taken the valuations at a point of time and we would have had the draft accounts ready by the end of May, and an assessment would have been made about whether those valuations were suitable for the accounts, and generally they were. I think COVID's produced some uncertainty about the valuations around our property and our pension liabilities, so that extra layer of work has come in, and that's part of some of the delay getting those valuations back up to date. Mark's also touched about needing information from outside of the finance team, so hugely reliant on the property valuers coming back with the updated valuations and the additional work that Mark's talking about on the property valuations there. I think extending the deadline is an interesting fact, because the longer you give people to do these things, the more information that you get, and then the more the assessment can be that it's maybe out of date or not as accurate as you'd like it to be. So I think extending the deadline is part of the problem, but you know, the external auditors will say they need that time to do the work that they've got to do. And I think Mark just touched on the additional requirements there for the auditors to look at how estimates are produced in our accounts, especially around the pension liabilities. And I know there was quite a lot of work between the National Audit Office brought together the actuaries that do that work and the auditors that obviously audit the accounts. So completely outside of the LCC or you know the local authorities' control about how that work happened. So I think there's just a number of factors. What that means for us going forward, we work into an end of September deadline again next year, and I imagine we might have some of the same problems next year. It's just about what we can do to mitigate some of those going forward, I think.
Thank you, Michelle. Perhaps we could have some sort of assessment of that at a future meeting when we get a little bit more clear after we've got this set process to know what the ongoing effects might be into next year. So if we can just put that on the sort of work plan somewhere, that would be beneficial.
I think a lessons learned would be useful. I think the other thing that we'll have to go through as an audit committee this year is, and something that will be on the forward plan, is the procurement of the audit service, and so as part of that discussion it'd be helpful to have as part of that discussion, I think, as well.
You indicated.
Yeah, I want to reinforce Councillor Allen's challenge. It is a pretty fundamental point. We've heard Michelle say we had retirements and departures but managed to backfill. Lessons have been learned in anticipation next year, which is your very important challenge, Chair. Disappointment is the word for me, that when you appoint one of the big audit firms, you expect them to have cover for almost any eventuality. And that is disappointing that the response to losing key people is to ask for an extension. Not very encouraging in an audit firm.
Thank you, Andrew. Paul.
I was going to cover off the same sort of thing. Succession planning is really quite hard, and technical skills are hard to come by, but large organisations have the ability to attract those sort of people in. So I'm a bit split on the explanation, but leading ahead, we've already had a change because of COVID on our audit date. So what I'm looking for clarification is, does our audit date go back to being what it originally was, in which case the time frame is even more tight, or is it 12 months from whenever we get our papers this time? Because that will have a major impact, as well as the fact that from the COVID point of view, people have been working extremely hard from home, and under those circumstances, maybe all of the effects, certainly from the mental health point of view, haven't come out yet. So there's a lot of pressure on all, and our staff have really managed well to date, and congratulations for doing what you're doing. Thank you.
Thank you very much for that comment. I think the COVID reporting has layered an extra layer of information over, and that's been part of the challenge with the accounts, about trying to understand what impact the COVID. We've had a lot of extra money coming through, a lot of extra grants, so just trying to get those straight in the accounts has been a challenge. In terms of the timelines, this year was a bit different and will be a bit different in that the auditors have got to produce an annual audit report. So rather than just producing a value for money opinion conclusion as part of the audit conclusion, they'll be needing to do an extra report, and that's part of the new code changes, and they're required to do that within 3 months of producing the audit opinion, and that is what Mazars are saying that they're planning to bring back altogether in November. So there's been a change this year anyway into how we report. Last year, you'll remember the deadline was extended to the end of November. This year and next year, the deadline has been set at the end of September for published accounts. So we've been working to September for this year, and we've already been told that that deadline will be the same for next year. And in terms of the annual audit report, that will be the same. They'll need to produce the value for money kind of information within that report. Obviously, prior to COVID, that deadline was July. Whether we go back to that deadline is all part of the discussion, I presume, and the new body that will come into play to replace the FRC in terms of how we move forward with those timeframes.
But it's really important so that we can plan. That piece of information is less than 12 months away, and the whole point of my question was how we're going to plan if we don't know. Thank you.
Thank you, Paul. Thank you, Michelle. Steve. Thank you.
Thank you, Chair. A different question really on the wording I've got here. I noticed on page 20, and I think a bit later on, under the significant audit risks, the paragraph, a number of queries remain open and are currently being discussed with management, but nothing that needs to be brought to the attention of members. Can I ask who makes that decision, whether it should be brought to members or not, and what criteria is used in coming up with that statement?
It's maybe something that Mark can comment on. It's part of the Mazars report.
Certainly, I can respond on that one. So it's our decision, and ultimately it falls with me, and it's based on what we call qualitative and quantitative factors. So in those instances, for example, we might be testing a sample of items where we've agreed, for example, we've got copies of the invoices. We're just waiting for the confirmation of when the item was paid in the bank statement. None of that would likely lead to an error in the financial statements, but obviously we haven't completed the work, and that's why we can't conclude. But the likelihood of there being an adjustment to the accounts is very, very low.
Thank you for that. A question I might have, though, is is there a list of those around somewhere that if we wish to see them, that they could be produced, or is it just something we have to rely on your professional judgment?
So two things that will come as a result of this. So firstly, I'll try to. So what we have is, we call it a tracker document, which we share with management, and that lists all outstanding items. Once we've concluded our work, we pull all of the items and errors together, and we have something called a trivial threshold, which we'll set out in our audit plan. If there's any items that would exceed that trivial threshold, then we will report them to the audit committee. So when you get our report in November, if there's any items that have led to an adjustment over trivial, which I don't have the number to hand, but it is circa £500,000. If there's any adjustments over that value, then we will itemise and report them to the committee.
Thank you, Mark, for that response, and thank you, Steve, for your question. Do we have any further questions on the County Council report before we proceed to the pension fund one? Okay. So we're noting the report accordingly. Okay. We're obviously waiting the final outcome. Okay. So perhaps we could. I'm not sure what the recommendation is. Well, I'm looking. Look back at the. We're asked to comment on the progress made on both audits. Well, we can't. We'll conclude that when we've heard the comment on the second one. But I think we've made good comments on the first paper. Yes, I think so. Yeah. Okay. Right. So if we can then proceed to the pension fund report, please. Thank you.
Thank you, Chair. I will take the pension fund report from Mazars. I'll take it as read, but I'll give a quick synopsis of the areas covered. To date, we've now substantially completed our field work and work on the financial statements for the year end of the 31st of March. As Michelle referred to earlier on in the meeting, there's just some very, very minor changes to asset valuations that have now come into the team to be embodied in the final version of the accounts. With regard to our findings and the work undertaken, we've liaised with the finance team, and they've made changes to the accounts for some very, very minor disclosure and wording issues. And the only thing to note is the difference in the valuations. With regard to the remaining work, we need to just do our completion work now before we give our opinion alongside the opinion of the County Council on the County Council accounts, which are of course in a combined document. With regard to our findings, I would also like to just clarify and echo what Michelle said earlier in relation to the difference of 37 million in terms of difference between the draft accounts presented for audit and the final version of the accounts, which will be different by that amount because of the adjustments that have taken place. In no way are we suggesting that this is sort of something that was avoidable. It's an inevitable part of the process, and as we say on page 17 of our report, the changes to the accounts were identified and proposed by the officers involved from proactively tracking the asset changes from the information that they were receiving from the investment managers, and it's an inevitable part of the process in terms of pension fund accounts where the unquoted investments are valued at a later stage. So in a nutshell, a fairly clean sort of view in relation to the pension fund accounts, and all we need now is the final few changes in terms of the values, and then we'll be in a position to sign off the accounts alongside those of the county when they are ready for sign off. So on that note, Chair, I would like to open up the report for any questions that members may have.
Thank you. Any further questions from members in view of the questions we'd asked already? Just one from the chair, while members consider if they have any further comments to make. Obviously, the adjusted investments of 37 million, that's obviously increasing the investment valuation, presumably. And,
It is indeed.
as we're obviously quoting debits and credits, which aren't necessarily in common parlance, but I think that's obviously clearly the case. We know that, you know, investments, particularly from March last year to now, have been quite, I mean, the investment market took a huge dip last March and then made a miraculous recovery very quickly thereafter. So one hopes we won't be seeing those large falls and volatility in the future valuations, but you know, the world's an ever-changing place. As you said, it's just part and parcel of the exercise that the valuations can be somewhat volatile sometimes. So thank you for enunciating the report to us, and we'll then pass to the members, I think, on the recommendation. I think, Mark, you would like to add the word disappointed in there somewhere.
I think from the comments that were made in relation to the council's audit, there was some disappointment from members that we've had the delay and have some uncertainties in terms of when the audit is actually going to be produced. We keep our fingers crossed it will be the end of November, and particularly have some concerns about what the next annual round is going to be and where that leaves us. But how we feed that into the recommendation, I'm not totally sure, Chairman.
The recommendation says that we comment on the progress made on both audits. I think we've actually done that.
As long as those comments appear in the minutes somewhere, maybe.
So that will be, we'll minute that for us. And obviously, as we discussed, we'll keep a watching brief with Michelle on how that's going to affect the progress for the ongoing audit when we come into the 2022 sort of season of working paper production. Okay.
Yes,
so
it will be on the agenda again for November. So obviously you can feedback those comments again when we do finally get the account signed off.
We look at the final set. So thank you to everyone on those two reports. So I have the recommendation, members. I will propose. Do I have a seconder? Thank you. All those in favour? Thank you. Thank you. So if we could then move to, and thank you once again to Ms. Ars for your input as well. So if we could move to item 6, which is the internal audit progress report. And Lucy, or I'm looking at Matthew. Lucy.
It's Alistair Simpson who's going to dial in to present that report, Chairman.
Hello all, thank you, Chair. Can you hear me okay? So just to confirm, just go through the key points from the report. We have 5 substantial assurance reports issued. One was come out as limited, which was on debtors. Tony Warnock, the operations and financial advice manager, is here to answer any questions on that one. We also covered some about the BW project, which at the moment its status is red. At the moment, it's being reviewed by external consultants NTEC-C. Report should have been shared with Council Senior Management in August, and a final report is being provided in September. Andrew McLean, who's the AD for Transformation Programme Performance, is again here to answer any questions you may have on that project and its progress. We ran the tracker, which picked up that 61% of the actions have been completed. 21% were not due and 18% were deferred. There were no high priority actions within that 18%. And again, another tracker will be run for the next audit committee. In terms of the plan, 24% of that is now completed. We have had a bit of a loss of staff, which has impacted with staff moving to other councils, secondment to the BW project and some maternity leave. And we've also had some recruitment issues where we tried to recruit to replace those, which is a national issue. We're now looking to build a team through apprenticeships, along with the continued use of external contractors. We're also looking to provide an updated audit and counter fraud plan to the November Audit Committee, which will be aligned to focus on the key areas that require assistance, and the service review is also planned for the next few months. The report then covers the substantial and limited audits and gives some brief outcomes and any findings. Page 55 then goes to explain the work in progress along with our work on grants, and a bit more detail around the BW redesign project we've been involved with. We also cover work done on the transformation programme. Page 57 then goes through our stats, with pages 58 to 59 covering matters of interest to the committee, the latest SIPFA Audit Committee update. And then we go into more detail around the tracker, progress on the plan so far, and further detail on why the debtors audit received the limited assurance. So thank you. I'll now pass over for any questions you may have.
Thank you, Alistair. Mark, thank you.
My question relates to the bit of the report that I found concerning, not necessarily worrying, but concerning, and it's to do with the increasing level of debt that's occurred. And there's a reference in there that's increased from £9.5 million to £23 million between January 18 and March 2021. But perhaps the more worrying element is, or perhaps a worrying element is the question about the disputed value of the debts, which has significantly increased within those values. And the reference is that that relates to deferment of debt, sorry, not deferment of debt, it's decisions pending on those debts. And that value seems to be increasing because there's presumably more decisions pending. I just wonder if you wanted to make any comments about that in terms of explanation. Is that to do with COVID? Is that to do with working from home? Is that to do with other factors? If you could perhaps offer some more comment on
that. Tony, do you want to field this one?
Yes, thank you. If you'll forgive me, I'll just make some introductory comments before I sort of move on to those answer those particular questions. I'm joined by Pam Clipson, who's the Head of Finance for Adult Care and Community Wellbeing. The reason for that will be clear in a minute. I just wanted to start, if I can, with just a latest fact, which I think is really relevant. And that is that £6.7 million of the £18.7 million of debt outstanding at the end of August 21 was more than a year old. That's 36%, which suggests to me that we may have a problem with debt collection. This year's audit report has highlighted one particular issue, but the finance team has felt for several years that we could markedly improve the position overall. So indeed, we actually put that as a key priority within our team back in 2017-18, and we've managed to carve out time from our existing resource to make improvements ever since. We've had some success with that. Indeed, over the last year, Pam and her team have made good progress in improving systems, processes and reporting, and they've cleared some of the oldest debt dating back to 2015. And that's against the backdrop that we've heard earlier on in this meeting, a backdrop of COVID-19, home working, and crucially, Pam's team playing a leading role in distributing, monitoring and reporting on a substantial part of the £100 million plus grants that the council's received from government for COVID-19 and for adult social care in particular. In that context, I believe Pam's team can be very proud of the improvements they've helped secure on debtors over the last year. Despite this progress, we're not complacent. We remain of the view that the debt position could be improved further. We don't truly know how much of an improvement we can make. Adult care typically accounts for 75% of the council's total debt. But the nature of its services and clients mean that debt collection will never be easy. For example, unlike the private sector, raising the correct amount of debt in a timely manner is often challenging. Nevertheless, a few months ago, Pam and I put together a comprehensive plan that we believe will drive the improvements required. Some of the detail of that is set out in the report, and all aspects of the plan are now in progress. Success will require a collective effort, including from colleagues in business support, Serco's credit control team, budget holders, senior managers, the IT team, and Council Serco contract management team. We are realistic though. We probably won't achieve everything in the plan by the time of the next audit in the spring, but that won't be through lack of ambition. We knew that Pam's team would be incredibly busy supporting a range of key strategic projects in adult care this year, and the government's recent announcement on the health and social care levy will add considerably to that workload. Yet that provides further reason to improve all aspects of debt collection. So we're being open and transparent about our views. We've shared the action plan with the Director and Assistant Director of Finance, as well as the Head of Internal Audit. And we've written the management response to the audit report in a manner that summarises the key areas of activity so that you and members of the public can see them. This will enable everyone to understand the challenges the Council faces and allow those tasked with helping deliver the plan to be held to account on progress over the next year and beyond. We will continue to monitor progress and we'll share details with colleagues at regular intervals. So that was the sort of introductory statement I wanted to make, but just in answer to those specific questions, in terms of the level of debt, reading the detail on page 54, you'd be forgiven for getting the impression, as I think you've just alluded to, that the debt has grown considerably from 9 million to 23 million over that period of time. Actually, the debt at the 31st of January in that particular year wasn't 9.9 million. It wasn't 9 million. It was 11.6 million, because that what was excluded from that figure was 2.2 million of debt that was carried over from the previous finance system that we switched from on the 1st of April 2015. So that's one particular point. And also the figures during the course of that year ranged considerably from 20.5 million to 10.9 million. So actually taking the debt as of that particular date, in my opinion, is misleading because it picks a very low figure. The figure actually over the course of the last 4 or 5 years is typically around £20 million. That's the kind of figure it's been. So there hasn't been a substantial growth in the level of debt over that period, as has been implied. And then in terms of the issue of the disputed debts, the impression then is that not only has it grown substantially, but a lot more of it is disputed. I think the other thing to bear in mind is the fact that Serco provide the credit control function on behalf of the council. And the points I'd make in relation to that are that, first of all, the council clearly pays Serco for doing that work. Secondly, as you'd expect, there's a key performance indicator that identifies whether they've achieved debt collection and whatever. And as you'd expect, there are financial penalties associated with that and other key performance indicators, such that if they don't hit them, then obviously financial penalties would follow. It's also recognised as well that in that environment, Serco can't control everything in terms of collection. Sometimes they will need the help of county council officers and whatever senior managers to help clear those debts. So naturally, when you come to use that KPI, what you do is you exclude items that are classified as being in dispute. But the problem with that is that that's subjective. You know, there could be a huge amount of work that's done in terms of collecting debt, or simply you could send out a few reminders and leave it at that and then pass it over to the council. So the fact of the matter is that over the last 3 or 4 years, more and more of the debt has been classified as in dispute. But I personally and the wider team, finance team, doesn't spend a huge amount of time looking at how Serco classify items as in dispute. What we know from our action plan and all the work that we've done and our day-to-day involvement in this kind of stuff is we know that there's more improvement that can be made. So rather than focus our efforts on, analysing whether Serco have classified things as in dispute correctly or not, what we tend to do is focus on changing the process and systems that I've described earlier to help improve. So I hope that answers the questions. In summary, the debt hasn't grown substantially over that period of time. It tends to hover around £20 million. And yes, Serco have classified more as in dispute, but they're not always as straightforward either as collecting, as again the report implies. It's a question of writing off or whatever. These things, particularly as 75% of it relates to adult care, need investigating, and that takes a considerable amount of time. So I would make those comments in terms of introduction in answer to those particular questions. Pam, I don't know if you wish to add anything to that.
Thank you, Tony. I think there's just three things that I'd like to add to that. The reason for the shift month in, month out, historically for adult care debt, is that we had a significant amount of transactions between ourselves and our CCG partners, and that could shift between £4 and £8 million per month, depending on when the invoices were paid. So one of the things that we've done within adult care is to agree a monthly cash flow at the beginning of every year, agree a payment date, and then as we go throughout the year, all we're adjusting for is adjustments to what's actually happened. And that's easing our cash flows and reducing the debt levels within adult care for our work with our partner organisations. I think secondly is we need to shift away from seeing our adult care service users as transactions and work with them as people and work with their financial positions. So for example, the reports that our frontline workers receive are thousands and thousands of lines long that don't really help them to make the decisions for the individuals that are in front of them. What we've helped adult care do is turn it into, this is the position for that individual person and what steps do we need to take to secure the finances for the council without sending that individual into financial distress. And we've seen a lot of benefit both for the individual and the council on the back of that over the last 8 months. But it is a very long road to get to and will take us at least until the end of this financial year, which takes us to the third action that we've given a commitment to do, that by the end of March 2022, we will have worked through every service user who has a debt to LCC in excess of £25,000, and we will have either resolved that with the individual and the cash flowing or have an action plan in place for instalment agreements or whatever is needed with that individual to prevent them going into financial distress. So I think a lot of work going on. We've had to review all of the processes, but as Tony says, we will have high levels of debt within adult social care. What we need to make sure is where they're secured, we've got all the paperwork in place to secure against the assets. Where they're not secured, that we work with the individuals rather than see them as a transaction that we then send out letters threatening legal action. Thank you.
Tony, thank you, Pam. Tony, would you like to come back on any of that or before I pass over to the members?
No, I have nothing further to add. Thank you, Chair.
The report to Tony and Pam's additional comments. I would just have one comment before we start, and these are debts and they need to be collected basically, and obviously from a financial point of view is what we're looking at here, not from an adult social care point of view. We've got to make sure that that isn't a growing and ballooning debt in the future, and it's only going to set to get worse probably from April 2022 in view of the new gross payment scheme. It'll be a bit like the landlord scheme, presumably when rents were paid directly to the tenant and then the landlord had to wait to be paid out by the tenant rather than the local authority, which still in some cases applies. So that sort of situation. So I think what we're looking for is the financial robustness of the collecting process. I think the adult social care implications are for the adult social care scrutiny committees to look at, and whilst we sympathise with people's personal circumstances, we need to actually control the authorities' finances, and we've got to get a lid on it now, not leave it until things get worse. I think that would be my comment. Thank you.
Thank you, Chairman. If I could come back, I think you picked the point up exactly. The purpose of comment at this committee is to do with whether debts are being collected or not, and I understand exactly many of the comments that were being made by the two presenters, but as you say, that's a matter for them in terms of how they classify it. What's important to us is that debts are collected and the level of debts doesn't increase significantly because it makes debt collection all that more difficult. And the only other thing I'd say is that we go on the information that's provided to us, and you can look at the information in a number of different ways. It's quite clear that there has been a big increase, although maybe not a big increase over the more recent period. But I did concentrate on the debt collection issue because that has issues in it, as I say, if we don't tackle the problem. And I was pleased that the comment was made, that some improvement is needed.
Thank you, Mark. Peter and then Andrew, please. Thank you.
Yeah, thank you, Madam Chair. Yeah, now we know every business has debt, so you set about minimising your debt. Here we've gone the other way. My concern is the rise in disputed debts, because my experience is that you do really, really struggle with them. The courts have been open many months now, so I would ask what actions we're taking now on courts, because we're in 6 months into a new year. And I just hope this trend isn't continuing. That will be quite a serious thing to this council. I just feel somewhere along the line, someone sort of lost it. We have a lot of finance staff here. We have a lot of well-paid, well-experienced staff here. I just wonder where it's gone silly. I don't want the word COVID thrown at me again, because, you know, we're getting out of that. Now, I have been told regularly by lots of people, including officers, that working from home became very productive and very efficient way of doing business. I'm seriously doubting that now, seriously doubting it, particularly in previous agendas here, when we've heard Mark, for instance, he commented 3 or 4 times that this challenge is due to COVID. I don't want to hear that again. So it's good old-fashioned hard graft and getting the work done when it needs to be done. Not, I've done my 7 hours, that's it. So that's where I sit, and I don't want the same conversation in a couple of months' time.
Thank you for that forthright approach, Peter, and obviously we hear what you say. Thank you very much. Andrew, and then perhaps we can come to, or Michelle, perhaps you'd like to come in first.
Yeah, if I could just respond and maybe provide not context, because that's another word probably we're in a lot of, but absolutely, this isn't a COVID issue. It was an issue before COVID, so absolutely right that this isn't a COVID issue. It's not about things breaking during COVID, because that's not the case. I think it was a problem for us before COVID. I think we've focused on the adult care stuff because that is where the majority of our debt is, and it's where the majority of the debt that needs following up is. In terms of where we get to a position with debt, this is about service user contributions, and there are some key elements here about we have a contract with Serco to undertake financial assessments of the people that use our adult care services, and that has to be done in a very timely way to ensure that we're collecting the contributions that those people are expected to pay in a timely manner, to ensure that we don't get into a position where the debt becomes more difficult to pay. I think the Chair's just touched on the decisions that have been made quite recently by the Executive to move to gross payments to our care homes. So just for information for the committee, we are moving to, at the moment, we pay our residential care homes a net contribution. So where service users are expected to pay towards their care, the care homes collect that from them directly, and we pay the balance. That's not really compliant with the Care Act, and we are shifting to where we now pay we're going to be paying the residential care homes the total amount that they're due for someone's care, and we were going to collect the contribution then from those individuals. So our debt will increase, and the debt that we're collecting will increase, and that's been in the process of being added to the strategic risk register. That's been highlighted by the Director of Adult Care as a strategic risk for the council as a whole, because our debt that we're collecting will grow because of that shift. I think this is about us working closely with Serco, who Tony's quite rightly pointed out are our contracted provider, to one, do the financial assessments of all of those people that are contributing towards their care and collecting the debt from them. We need to work with them to make sure that as a council we've got those processes running as well as we can, to ensure that we mitigate as much of the debt that we can in terms of debt outstanding. I hope that provides some context. And you're absolutely right, Councillor Cooper, this isn't a COVID issue. It was in place a long time before COVID, and is just being compounded now by the move to gross payments to our care providers for their care.
Thank you so much,
Chair,
Michelle. Just before
Chair, if I may, could I respond to the comments too?
Yeah, certainly. Can I just ask Michelle one further question, Tony, if that's okay? Do we have would there be some sort of level of cap on how much debt we would feel would be acceptable, Michelle, to the authority? Because collecting it from individuals is going to require extra work, probably extra staff to do that, because you're going to, instead of dealing with a finite number of care homes, you're going to be dealing with 20 times that many, or probably even many more times that many individuals.
Yeah, so there's two bits there. There's the move that the council's decided to make to pay our residential care homes gross of contributions, and then there's the next bit, which is the government announcements about cap on self-funders and that takes us to a whole other level, I think, in terms of the work for us as a council and the work for whoever does our financial assessments. You know, we can suddenly have twice as many people in the pool for requiring a financial assessment, and that's going to, but that obviously doesn't come into effect straight away. The gross to net thing is a more immediate concern.
Particularly, if I could just come in again, particularly on the sort of increases in terms of the provision of adult social care assistance and people who can provide that in care homes and in the community, then the pressure on the workforce community is only going to see wages rise probably ahead of the minimum wage, and maybe substantially ahead of the minimum wage. So I think we need some sort of assessment strategically of where we think we're going to head on that. What's some sensitivity analysis about what that might be, because we can't accept a bottomless and ballooning risk, can we? And I know it's asking like to sort of to plat fog in a way, but we need to sort of try and get a head around what that might be. And I'll come back to Tony in a minute for his comments as well.
Yeah, you're absolutely right. We need to make some sense of the announcements from the government about the reforms in adult care. I think the government are going to expect us to report quite significantly on the reforms and the impact on both the contributions that are being made and the administration of all of that. So, absolutely one for the future. We will need to respond to what the demands are going to be around the adult care reforms. I think ahead of that, we need to get our own ship in order first to make sure we've got the processes in place to undertake the debt collection that we already need to be doing.
Tony, would you like to come back? Sorry to cut you off before.
No, that's fine. It might be appropriate actually for Pam to come in on that point, because I think her comments were probably relevant to what's just been discussed.
Yeah, thanks, Tony. I think there's two bits in the move to gross, which we're envisaging to be April 2022. We've already started the discussions with our care homes now to understand the level of debt that service users have owing to each of the care homes. And that will give us an idea, we're hoping this side of Christmas, to understand the scale of debt that we would take on that already exists within our market. And the second element that we are also having discussions with, our conversations have started with the 3,000 service users in receipt of residential care now. And our aim is to help them from now through to April to transition in the most effective way to collect their service user contributions. So, for example, direct debits, all pays, and avoid actually the more long-winded and challenging way of getting those invoices raised. So we do have a project team that is overseen by the Director of Adult Social Care, and that's already commenced with the 282 providers and the 3,000 service users. And that project team will continue until the move to gross is embedded in 22-23. Thank you.
Thank you. If I could just come back then to some comments on the previous comments that were made. So first of all, I'm repeating what I said earlier, but I think it's important. The perception that the level of debt has grown tremendously from a few years ago is not correct. Back on the 31st of March 17, the total debt was 17.6 million. A year later, it was 20.5. A year later, it was 21. A year later, it was 22.1. And a year later, it was 23.8. So it's been at that magnitude. Secondly, the point about disputed debt is something that Serco classify, and it affects the way that their KPI is reported. So I wanted to get those key points across. And related to that, absolutely, the finance team has a large team, has a lot of responsibilities, but the council does contract with Serco to do that credit control function. So as I pointed out in my opening statement, there are a range of parties to making this a success. I listed those earlier. Serco are one of them. We're part of it too, but then equally senior managers, budget holders, etc. They also have a role to play in as well in this as well. So apologies for repeating those points, but I think they're really important to get an overall sense of the position on debtors. We do think it can improve. We do have a detailed action plan to improve it, but I don't want it to be misconstrued. Thank you.
Thank you, Tony. That's very helpful. Just pointing out the actual level of debt at the end of each year. Clearly, that helps us understand what the comparatives are from year to year. And so I'm sure as a committee we all understand the pressures that people are under trying to collect these debts. But I think in view of the current circumstances and people's and the changes coming through in the pipeline as well, it would be a disservice, wouldn't it, to people who do find themselves in debt to us, that they get to a position where they just can't pay that debt at all because it becomes too onerous for them. So we do understand and look at it in the round, and we're obviously very grateful for our staff's contribution in helping us resolve these things, and looking to Serco to their performance as well. So if I could just bring in Andrew first, and then perhaps Mark Whittington, who's remote at the moment, and then Paul, and then we'll work around it that way if that's okay.
Thank you, Chair. I'm not unfamiliar with this problem because I chair the Continuing Healthcare Committee in Derbyshire CCG. And we are looking at some pretty scary numbers that are growing in all the wrong directions. I think the solution lies partly not in, and I'm quite assured that the finance team has got a grip on this issue, is trying to stop the issue becoming a bad debt in the first instance. And the key to that we found in Derbyshire is the appropriateness and timeliness of assessment, the timeliness and rationale in the communication with the family and the service users, because you are fighting an expectation that healthcare, that's free, isn't it? And it's a very, very murky and difficult area to have a rational conversation with service users and their families upon. But we have a duty to spend public money soundly and within the rules. And whilst we are mindful of the pressures and the difficulties this is causing families, and adult healthcare is a massive cost, which I have personal experience and sympathy with people on this. If you don't take the right action in a timely manner and a definitive and robust way, you tend to feed expectations that, oh, we needn't bother with this, we needn't bother to pay it. If we spread out long enough, then maybe it'll get written off. And I think the whole student debt scenario has helped that perception amongst the public. So my question, Chair, is do we need to have not the finance team answering our challenges, but the Director of Social Services and the Serco team who are making the assessments, and what are their systems and control to ensuring they're timely and appropriate?
Thank you, Andrew. I don't know, Michelle, would you like to make any comment on?
I think you're absolutely right. The financial assessments, particularly with adult care debt, is absolutely crucial in terms of making sure that you've raised the debt when you should have done in the first place, and then collecting it in a timely manner. And both are two teams separate in Serco undertaking that work, debt collection and financial assessments. It probably would be helpful to have some feedback on that in future. Maybe Lucy just wants to comment on that.
I can make a note for it for the work plan, but I just wanted to clarify around it being escalated to the strategic risk. The strategic team are meeting with the Director of Resources and Adult Care to discuss this particular risk, looking at the control actions. So one of those control actions will be around the financial assessments. So, and that I can do a briefing paper to the committee about the outcome of that discussion. So whilst they will also, the Director of Resources and the Adult Care will be at the committee in February to talk around their combined assurance. So I'm just conscious that they will be attending the committee for you to be able to look at that, but I'll brief you if that's okay, rather than having something on the work plan.
Thank you, Lucy, because that would be more timely and it would keep us all up to date.
If I might add, Chair, I think that's an encouraging step. I am not comfortable when I'm told that we always have 20 million of debt, and a fair chunk of it is over 12 months, which makes it very, very, very difficult to ever resolve. And going to gross, I predict, is going to increase these figures quite considerably. So I would say it is a strategic risk, and if it's 3/4 of the council's debt, it's got to be a strategic risk, hasn't it?
Thank you, Andrew. Are we bringing Mark in? David?
Oh, hello. Good morning. Thanks. Thank you. First of all, my apologies, Madam Chairman, for not being able to attend in person. Obviously, I attend these meetings as Councillor Hill Support Councillor. I've got another online meeting at 1 o'clock, which follows this one, so I couldn't have been in Lincoln. So that's why I've joined remotely today. My question really, I mean, just following on the conversation, the last 2 or 3 speakers, is there just seems to be a massive amount of potential risk that's been highlighted here, and it's encouraging. There's going to be a meeting between Andrew and Glenn to try and discuss this. But I think my concern kind of relates to some of the points I think that your previous contributor made. I mean, and I see the potential danger with a lot of this historic debt is that obviously the majority of sort of adult social care service users are quite elderly, and my concern would be if there are elements that are in dispute, that potentially, unfortunately, service users pass away. The family then sort of divides up the estate, and potentially there's nothing left in the estate, but anyway, for us to make our claim against. And I'm just wondering how we deal with this, and because there must come a point. I know the point that some of this debt is 5, 6, 7 years old. Well, if that service user's passed away and the estate has been devolved, passed around, I don't think there's going to be anything left for us to sort of go against. So I'm just wondering how we deal with that, and then ultimately how we then ultimately decide that we just need to write this off, and what would be the process and protocols around writing it off. Thank you again, Madam Chairman, but I'm sure I'll discuss with Councillor Hill this discussion after the meeting, because I think he'll be quite interested to understand some of the risks that the council are facing. Thanks again. Thank you.
Thank you, Mark. And yeah, I think you can appreciate that we're all, sort of quite concerned about the ongoing picture, if not the historical one as well. In terms of, Tony, I don't know whether you'd better to answer this. In terms of putting a charge on somebody's estate that could be ensure a contribution from an estate, how can we do that? Is that possible?
I mean, I'll let Pam come in on that, because it's in adult care and we can secure debts on property, and over time we've probably had £4 million of debt. So again, when I quote the figures, they're debts that are over a year old. Again, that needs to be factored in as well. But Pam knows the details, so I'll hand over to Pam on that.
Thank you, Tony. Yeah, so we started the review about 8 months ago, and we worked for the exact reasons that Councillor Whittington's just raised. We worked on the oldest debt first. Part of that did include ensuring that everything that could be secured, that our paperwork was put in place to make sure that those debts are secured against whatever assets the individuals have. And that was one of the work streams. We have updated the process again. That's due to go back through our adult channels through October and November. Now what we're reverting to is the debts that are in our 0 to 30 days age bracket, and again reverts back to one of the councillor's comments earlier. What we would like to do is shift it to it actually getting to a point where we're working with social workers before it becomes a debt. We started with the oldest, we're now on the 0 to 30, and the processes that we're looking and putting in place between now and the end of December will actually work with what we've got to call our finance champions within adult social care. We've put a debt review group in place for escalation for our frontline workers to come to for advice earlier than before it becomes the debt. So our aim by the end of this financial year is to get processes in place to get it earlier on. But yes, we have throughout 2021, we did have to write off some levels of debt for the really old debt the council was holding. And that was for 3 reasons, really because of the distress for relatives and families who had died. And we also have legal limits around the law of limitation and the HASAR for property debts that after 6 years and 3 years respectively, we could no longer chase anyway. We have now gone through that and that piece of work is concluded. So now for this financial year, we're into the process change and then moving it to the very much earlier on with our finance champions who are social workers within the adult care team. Thank you.
Just to come back, Pam, in terms of if people can't afford to pay for that care that they desperately need at the time, do I understand it correctly that we can take a charge on the property? And if so, are the social workers knowledgeable about that process, that we can get that charge in place as soon as possible? And I'm heartened by what you say about trying to sort of, obviously, as you say, it's getting the debt not to arise in the first place. So doing these procedures within the first 30 days is eminently sensible. I'll totally support you on that. But should the need arise, do we have systems in place to actually claw back the money from a user's estate?
Yes, where they're eligible and their assets are eligible, depending on whether they're single, married, etc., we have now got those processes in place. If we're unable to secure against the property due to the regulations, we are putting instalment agreements in with families so that if they couldn't pay the full bill up front, then we will agree an amount that they can contribute affordable to them, result from their financial assessment, but for a monthly sum over a period of time that is affordable. So there are now various mechanisms that we've put in place through agreement with the Director of Adult Social Care to ensure that where possible that money is brought in as quickly as possible. Thank you.
Thank you, Pam, and thank you. Tony, did you want to come back? Are you?
No, nothing further to add. Thank you, Chair.
I've lost track of who had the hand up next. Paul.
Thank you, Chair. This is quite an emotive subject. It goes way past the monies that we're supposed to be considering. It goes down to appropriate care to people and assessing that need at that point of when they come into the service. By the sounds of it, I'm very, very disappointed with this paper because the figures are all over the place. I quite recognise the Vice Chair's wish to have somebody come to the next meeting because I don't know where the hell we are with this paper, to be quite honest. I'm being told that we have a debt, it's bigger than that, it's smaller than that. I would really appreciate somebody coming to this committee and actually telling us what this paper is properly about and who feels responsible for it. Because to me, everything I've listened to this morning would suggest it's totally out of control. Thank you.
Thank you, Paul. Steve,
I just really wanted to say the same, really, that in terms of figures and so on, we've got a lot banding around and it's a bit confusing to know exactly where we are and what the situation is, and also who ultimately will be liable for debts which aren't paid, how much is going to be written off, etc.
Thank you, Steve. Andrew, would you like to come in at all, please? I'm looking over at
Yeah, sorry, I missed part of the debate. I had to take an urgent phone call with something that I'm dealing with today. But I completely hear everything that the committee is saying, and I think, in line with Lucy's suggestion, a detailed update at the next committee, if that's suitable for members, along with Glenn, and if we can get somebody from Serco as well, we'll come along and provide a more thorough update, if that's okay.
Could we arrange that, Lucy, that we get Glenn and Serco to come and see us before February? I hear what you said about the brief.
Yeah, I will endeavour to do that and get back to you if there's any issues.
Members happy with that suggestion? Okay. And once again, I'd like to thank all our contributors. I know the debate has been rather intense, but then that's what we're here to do. So thank you to everyone. Any further points on the paper before us on internal controls? Andrew, thank you.
Well, it's a small but positive point, and it's a bit of a broken record with me. Lucy knows that I'm a big fan of apprenticeships. Well, we've got the manifestation of how it's so positive before us. I believe that we as public authorities, be it health authorities or county councils, have both the capacity and arguably the responsibility to create entries into careers for our local populations. And I would wish there to be a policy position which says we are not going to only train the 20 or 30 apprentices which we can clearly identify we are going to need in 3 years' time. I would wish them to go to 100 or more as part of a double banking of our own staffing needs, but also a contribution to the wider community benefit, assuming we can get value out of the apprentices to some extent. And indeed, Lucy and I were involved in this at a time when that was the philosophy. The Manpower Service Commission drove a view which said we are going to train massively because there will be a slot to put them into at some point. So I don't know what the HR policy position is in this council, but if I were able to influence it, I would urge that they double or treble that number of apprentices intended, because A, they're likely to be needed in the county council or in district councils, or there will be a contribution to local community employment pool.
Thank you, Andrew. That was obviously a key topic in the rest of this paper as well, was the fact how we're going to fill vacancies and encourage.
I don't know what the targets and stuff, but again, I can liaise with my HR colleagues and give you some information around that. But I can assure the committee that the council recognises the importance of, and indeed in my own team, of apprenticeships through succession planning, and not just obviously new to the workplace, but ongoing skills with the skills agenda. So apprenticeships is not just for people new to work from the academic or schools, it's for all. So we recognise that. So I can give that back to, again, a note to the committee.
Thank you, Lucy. So I have any other members wishing to speak? Okay. So we have the recommendation that committee notes the outcomes of the internal audit's work and identify any necessary actions that need to be taken. I think we've done that robustly. Thank you, Mark. Do you have a seconder, please? Thank you. Robert, listening. All those in favour? Thank you. Thank you, Robert. If we could now move on to item 7, which again is probably some issues on risk we debated on item 6, the risk management progress report. Matthew. Thank you.
Yes, thank you, Chair. That's me. Debbie wasn't able to make it, so I'll just be presenting the paper. So I'll take it as read and just focus on the key issues. If you look on page 73, that just gives the key messages from the risk progress report. And I think really a couple of the key ones in the key messages that we continue to report to CLT quarterly. So there we liaise with all the directorates and we pick up the high level risks, and we have that ongoing reporting and dialogue with CLT, so that's really useful for assurance. And also that we've had a facilitated session with CLT and the assistant directors about risk appetite for the council. And all this is ongoing into an ongoing update of the risk management strategy and review, which I'm sure when that's completed will come back through the committee. Pages 75 and 76 just give you that brief update of the strategic risks. And I think the key one to note is the risk around the transformation programme. That's the only one that's changed. And that's to do with the fact that they've been redefining this transformation programme, linking it with the new corporate plan. And so that's moved from substantial assurance to limited assurance. And then generally on page 77, when we look forward to the work that we're going to be doing, again, that just gives some details around the continuing support and that transparency on risks with CLT and working with services and also updating and refreshing the risk management pages and the risk management strategy. And I'm happy to take any questions that anybody has. Thank you.
My microphone on when you were speaking, I do apologise. Looking for questions to Matthew regarding the risk register. Andrew, thank you.
Safeguarding children is something that's getting a lot of attention, quite rightly, because they are a significantly vulnerable group. And can you please talk me through the team discussion around the emerging evidence of mental health concerns, concerns about domestic abuse, and all the things that have been the downside of COVID and the absence from school, etc., etc. Has that risk score increased as compared with the previous assessment, or where do you think the trend is?
So I'm not privy to that. Our risk officers have done the work. I'm just presenting the report on their behalf. But I think we can get that information back to you. As far as I'm aware, the risk score overall, that limited assurance hasn't changed. But there will be a load of stuff in the background around the controls and risks and mitigating actions. So we can ask them to look into that and come back to you.
It would be useful to see that dialogue
yes.
about what's gone up, down. So,
thank you, Andrew. Any further questions for Matthew? I was just going to, just bear with me a moment because I'm flicking through my papers. I've lost the spot when I was going to ask you something. I note that you've said, obviously we're going to look at some new risk management software, Sharp Cloud. Can you just give us a little bit of a heads up on that, Matthew? Thank you.
Thank you, Chairman. So we're looking to change the way we report to make it more dynamic and visual so you can drill down. So it's a sort of real-time software, so rather than taking away the spreadsheets and the paper, so hopefully we'll be able to bring that to the audit committee as well, so you can see all that detail behind that in real time.
That'd be great, Lucy. Would we need a bit of a preamble or a few minutes sort of training? I don't like to use the word training, but you know what I mean, some sort of so induction for.
There will be some familiarisation with what the information is saying, so we will be looking to run a webinar or a little brief workshop on risk management to make that bit more live, particularly as we're reviewing the strategy, so we were going to do both when it's timely.
That's great, thank you. And obviously, I don't think what we're seeing here is no real surprise in terms of what we've discussed before in terms of transformation programme, market supply and adult social care and cyber security, which are three of the larger things. Steve.
Thank you, Chair. I've been looking at the tables where you've got the limited assurance, etc., and whether they're improving and static. I noticed that most of the limited assurances are in a static situation. Is that something where we should be concerned? Because presumably if it was limited, you would want to see more improvement going on.
It is an area for the audit committee to have scrutiny and challenge. So again, the risk owners are there. So if that's an area that you want a bit more information on what's being moved and the developing controls, that again, that's something that we can go back to the risk owners.
Thank you, but it will be something which I feel needs to be looked at one stage or another.
The February committee in 2022 will have the executive directors here. So again, one of the areas that is part of that discussion is the strategic risks. So again, I will ask the executive directors to focus on some of those control actions if they've not moved by the time that it comes to the committee.
Any further questions to Matthew or for Lucy regarding this report, please? You can, Mark, yes, we'll have a seconder, please. Thank you, Paul. All those in favour of the recommendation is noted. Thank you very much. Thank you. So if we can now move to the external quality assessment, the internal audit. Lucy, we did have some brief discussions around this. So.
Thank you, Chairman. So this report sets out the proposal for the internal audit's external quality assessment. We are required to conform to the public sector internal audit standards, which are around to maintain quality, consistency and conformance to those standards. They're quite a rigorous process. In 2016-17, we had a full assessment when the standards were introduced, and we are required to update that external assessment every 5 years. During the interim period, we have a quality assurance framework, and we do self-assessments and report each year in the annual report around our quality assurance framework. But every 5 years, we should have the external assessment. So the report sets out the approach, particularly around the independent. Obviously, I'm the head of internal audit, so it requires some independent sponsorship of this work, which I'm proposing the chairman and the assistant director of finance to be that project sponsor and agree the terms of reference and oversee the delivery of the external assessment. Since the time of writing, I've liaised with some of my peers within the internal audit community, and one of the things that they've suggested that might be an alternative, a way of doing it, is we've recommended a full self-assessment, but to give the chairman and the AD a bit more choice, a validated self-assessment is also an option for an external assessment. So I'm just proposing that we procure a quote for both approaches, so that the chairman and vice chairman and the AD can have a choice around quality and value for money for that. So this is just a suggested change to the recommendation 1, that the validated self-assessment and a full external assessment is secured through a quote to compare and contrast those two delivery models. So I think the paper sort of sets the framework out. Both involve a qualified external assessor, both require a self-assessment completed and evidence being supplied. The difference between a validated self-assessment and a full assessment is the validated self-assessment is more virtual and there's less workshops with the committee. But it will set out that for the decision to be made by the chairman and the AD. So I think that's it really, if there's any questions really.
Chair, I've got quite a lot of experience of validated self-assessments. When I was an Ofsted inspector, it was a very substantial part of it. And I've therefore no reason to doubt that it can give us the assurance that we need. Another type of assessment that I would also recommend, based on experience, is that Lucy takes herself off to do an external review of Hertfordshire, say, and they in turn come back and do a review of us, which is mutually beneficial because you always learn something useful from another authority, And you can also assume that there is an objectivity and an independence of challenge on that. So that could be nil cost, except for the travel maybe, and that might be a stage you would put in somewhere in this. But in principle, I don't necessarily feel that the added benefit of a full external assessment would be required or affordable or best value in these straitened times.
Thank you, Andrew. Do you have any further thoughts on whether we go for more restricted self-assessment or a full external assessment like we had last time? No. I think so. I acknowledge what Andrew said in terms of, you know, if it's approached in the right way, then I think you can get a lot of benefit from a self-assessment issue as well. But clearly, with I think Lucy, you suggested earlier, with sort of remote meetings and things, we could have some sort of a halfway house as well. So there is quite a lot of scope to get something that would be both cost effective and efficient at the same time, and effective, of course.
I thought if I procure for the suppliers and ask for them for an approach for both and a cost for both, you'll be able to make the decision on a value for money. But as Andrew said, the validated self-assessment is a robust process. In terms of the sharing, I did consider that, but I just don't have the capacity to do that sharing at the current time. So whilst that would be less obviously free because it's a mutual sharing of head of internal audits, the logistics and the timing of that is just not appropriate at this time.
Paul, you second, okay? Okay. That's unanimous. And then we move on to the final item, item 9, which is the work plan.
Thank you, Chairman. So the work plan obviously tries to help the committee keep track of what's on the forward agenda items. November the 15th is our next meeting. As you can see, it's quite a full agenda, which includes the smart working update. I think was one of the issues that came up in the previous discussions on the previous audit committees, and also you've mentioned some other items to come at the committee, particularly the follow-up of debtors. So again, I will seek, and also a discussion with Glenn and Serco. So I will try and get that for the November committee, but I'm just conscious that it is filling up. So I try working with the chairman. I know about timeliness, so I will liaise with the chair and vice chair around how we can move those things forward in the agenda. The next meeting after November isn't until the 7th of February, but that again has got a dedicated assurance meeting which you've asked for before, where you get the directors to attend, so you get CLT for the whole of that meeting. So again, that might be an opportunity to talk about some of those other issues. So maybe that's something the chairman and vice chairman and the rest of the committee can reflect upon. Thank you.
Any comments, members? No. So we're all happy to note the work plan with the provisos, as Lucy suggested, regarding the debtors controls. Okay. Thank you. Okay, all in favour, show please. Thank you. That's it. Great, thank you. So I think that everyone concludes the meeting. So thank you for your attendance, and the fire alarm didn't go off, so I didn't have to go and stand outside, which is very good. So anyways, safe journeys everyone, and thank you for your input at today's meeting. Okay, thank you.